All right, in this video, we're going to go over the Chapter 7 challenge exercises. These problems were posted on Blackboard. Hopefully you had a chance to attempt them, and then we can, with this video, walk through the solutions. I will also post this PowerPoint on Blackboard so you can look at it in more detail of how the problems were solved. Again, these challenge exercises are meant to be a challenge. They're a little bit more difficult than what you will typically see in your homework and on the exam, but I think it's a good way to see if you grasp really what the concepts are in the chapter, and then you should be able to apply those concepts to your homework and in the exam a little bit better. So some things that are unique in these problems you won't see again on the exam, but hopefully thinking through this and seeing how things are solved with these exercises will make you better prepared. So let's get started. First question, Conklin Company manufactures outdoor fireplaces. For the first 9 months of 2020, the company reported the following operating results while operating at 80% of plant capacity. So we had sales, gives us the units there, 75,000 units, and then the dollar sales for dollars amount for sales, cost of goods sold, gross profit, operating expenses, and net income. And then it tells us that cost of goods sold was 80% variable and 20% fixed. That's going to be key, as you see on the next slide. Operating expenses, again, were 70% variable and 30% fixed. Remember, when we're talking about costing and relevant costs, we're going to look at usually variable cost, sometimes fixed, sometimes we have to reallocate it and that type of thing, but usually they don't change, but the variable costs are going to change with the levels of sales or production depending on what we're analyzing. So the income statement they gave us, even though it's a GAAP income statement, doesn't help us in that regard, so this extra information is very helpful. In October, Conklin receives a special order for 4,000 fireplaces at $62 each from Langston's Landscape Company. Acceptance of the order would result in an additional $7,000 of shipping costs, but no increase in fixed operating expenses. Instructions: prepare an incremental analysis for the special order, and then should we accept the special order, why or why not? Okay, so we're going to do a accept or reject analysis, incremental analysis on this. So in order to start this, we're going to go through some calculations, and we're going to break down and get more of a gross margin view, separating the fixed and variable costs, and looking at some per unit basis. So we'll start with the calculations. Our sales price, $6,750,000 divided by our 75,000 units gives us $90 per unit. Okay, so the special order is significantly under that, but we need to see if it still makes sense. We have to finish the analysis. Cost of goods sold, $4,875,000. 80% is variable, 20% is fixed. So we just multiply that amount by 80% to get our variable amount, $3,900,000, and times 20% to get our fixed amount, $975,000. And then we can go ahead and get the variable cost per unit for cost of goods sold by taking the $3,900,000 divided by 75,000 units, and we get $52 per unit. We'll do the same thing for operating expenses. That was $750,000 in total. It was a 70-30 split between variable and fixed. So we apply those percentages. We get $525,000 variable, $225,000 fixed. And then we take the variable divided by our 75,000 units to get $7 per unit variable operating costs. Okay. Now that we have this, we can apply some of this data to our reject or accept analysis. So we're going to have our three columns again, like we saw in the lecture. We're going to have the reject order. And if we reject the order, we have no incremental revenues, no incremental cost, no incremental income. So it'll be all zeros in that column. So then we'll really have to fill out the accept order column, figure out what goes in there. So we're going to have our revenues. So $62 per unit times the 4,000 units will be our revenues. And then we'll have our costs, and we're going to look at our variable costs for this. So we'll have cost of goods sold at $52 per unit. Our operating expenses at $7 per unit. Fixed costs should not change with this order because we're under capacity, so we have capacity, so we don't have to expand or buy any new machinery. And then we have to include our shipping expenses as well. So that's that accept order column. And that comes down to, it would generate a net income of $5,000. Then if we look at it compared to the reject order, which is all zeros, that $5,000 will be our net income increase by accepting this order. So based on this financial analysis, we should accept the order. But as happens in business, some things change. So before we could officially give an answer to Langston Landscape Company and say that we're going to accept that order, we received another special order from Benson Building and Supply for 15,000 fireplaces. Benson is willing to pay $65 per fireplace, which is a little bit better than what Langston was paying, and there's more fireplaces. But they want a special design embedded into the fireplace that increases cost of goods sold by $67,500. Okay, so we're going to increase some costs. Got to figure out what that impact is. Special design also requires the purchase of a part that costs $5,000 and will have no future use for Conklin Company. Okay, so again, that's going to be a cost that we have for accepting this order that we'll have to put fully on that order. Benson Building and Supply will pick up the fireplaces, so no shipping costs are involved. Due to capacity limitations, Conklin cannot accept both special orders. Which order should be accepted? So we're going to do another incremental analysis for this second order for Benson. It's going to look a lot like what we just did. So we're going to have the same columns. Our reject order is going to be 0 again. The accept order now is going to have this new information. So we'll have 15,000 units at $65 for our revenue. Our costs are going to be changed. So our $67,500 of extra cost that we need for that special design is going to be included with our cost of goods sold. So if we take that 67,500 divided by 15,000 units, it's going to be $4.50. So I just took the 67,500 divided by 15,000. We're going to add that to our per unit cost for cost of goods sold. So the $52 we had before plus that $4.50. Operating expenses don't change, so it's going to be the 15,000 units at our variable cost per unit of $7. And then we have to include the cost for that unique part. So it looks like this. $975,000 of revenue, costs $847,500, operating expenses $105,000, and the $5,000 for the special part. But we still get a net income positive $17,500. Okay, so now we have to decide which one to take. Based on the financials, we should take this second order because it gives us $12,500 more income than we receive from the first order. So we could have done another incremental analysis to show the income for option 1, which was Langston's $5,000, and then the option 2, the Benson, $17,500 net income, and seeing that difference by line item. You could see the increase in revenue, the higher cost, but then the higher profit as well. So, but pretty simple math, so we didn't need to show that detail, but that would be, if you're in a more complicated situation, that would be the next step, is to do another incremental analysis between the two special orders. since they both were positive, and we wouldn't reject one just on its own. Okay, now we'll look at the second one. Safe and Secure Incorporated produces 3 models of home security systems. Information on the 3 products is given below. So we have sales, variable expenses, our contribution margin, our fixed expenses, and net income for the 3 models: Assurance, Decoder, Burglar Beware. Fixed expenses consist of $450,000 of common costs allocated to the 3 products based on relative sales, and additional fixed costs of $45,000 for Assurance, $120,000 for Decoder, and $52,500 for Burglar Beware. Okay, so what this means is the total that you see for fixed expenses. So in insurance, it's $180,000. $45,000 of that is directly only related to the Assurance product. Okay, so if that were to go away, that $45,000 would go away. The rest of that, $135,000 of fixed expenses for insurance, is common costs that was allocated to Assurance. Those fixed expenses will not go away, so we'll have to allocate those to the remaining products. Okay, and we could do the same analysis for Decoder and Burglar Beware. So there's going to be some additional fixed costs that hit Assurance and Decoder that we'll have to be aware of and factor that into our analysis. The other thing that we need to clear up here is that the allocation is based on relative sales. So that's a little bit new terminology than we've seen before, but what it really is looking at our sales mix, what percentage of the total is each product, and multiplying that percentage by our fixed common cost, the $450,000. So that's how the allocation works. It's the percentage of the total sales for each product, and that's how much they get allocated to the product. So Matt Dillon, an executive with the company with extensive law enforcement background, feels that the Burglar Beware line should be discontinued to increase the company's net income. So if we look at the income statement, it's losing $60,000. Yeah, it's dragging down our total, but we have to go through the analysis to figure out if it really would increase the company's net income. So we've got a number of steps to take. First, we're going to compute the current net income for Safe and Secure. Okay. What all that entails is taking those income statements by product that we just looked at and adding them together. So sales, the 450, the 750, the 300 become 1,500,000 for the total company. We do that for each line, calculate net income for the company, $90,000. Okay. Next, we can compute net income by product line and in total for Safe and Secure if the company discontinues the Burglar Beware product line. Okay, so if we get rid of Burglar Beware, we're going to lose $300,000 of revenue. So our revenue is going to decrease. Our variable cost will, for Burglar Beware, will be gone. So our total variable expenses will go down. But our fixed costs, not all of those $142,500 under Burglar Beware is going to be eliminated. So remember, there's $450,000 of common costs that we have to reallocate to Assurance and Decoder, and then add that allocation to their individual parts that we saw on the previous slide that had small amounts that were just for their product lines. Okay, so that's what we're going to do next. Again, we're going to allocate the $450,000 based on sales. Okay, so relative sales is the terminology they use. We're basically taking the sales for the product, 450 for assurance, 750 for decoder, dividing it by the new total, 1.2 million. That percentage times $450,000 gives you the common allocation of fixed expenses. So we see that common line there, $450,000 total. That's the allocations. And then they had their unique fixed costs as well, $45,000 for insurance, $120,000 for decoder. So when we generate this new income statement with the way the company would look with eliminating that burglar beware, we see that our net income is $60,000. If you remember from the previous slide, our net income with burglar beware was $90,000. Since the net income goes down when we eliminate the burglar beware line, because we're spreading that $450,000 across just the two instead of the three components, our net income decreases. We don't eliminate all of that fixed cost in that that was allocated to burglar beware. Our income goes down, so we should not allocate it, even though that product itself is running at a loss. The company is better off with it. So now we're going to change some assumptions. Assume that the fixed expenses consist of $150,000 of common costs, so a lot less common fixed costs than our last example. Our additional fixed costs that are specific to the products are $130,000 for assurance, $295,000 for decoder, $92,500 for burglar beware. The common costs will be incurred regardless of how many models are produced, just like we saw before, except we just had a higher amount of fixed costs that had to be spread over fewer products. Compute the net income by product line in total for safe and secure if the company discontinues burglar beware product line. Should safe and secure eliminate the burglar beware product line? Why or why not? So we're going to do the same analysis that we just did. We're going to look at the income statements for the two products and in total and decide what to do. So as you see, the contribution margin is still the same, $675,000 for the company in total. Our fixed expenses are a little bit different. So our unique that are only for that product line are higher than what we saw before. So $130,000 for assurance, $295,000 for decoder. And our common fixed expenses, the $150,000 stays, and we're dividing it by two product lines instead of the three, so $75,000 each. And when we add this up, we get $100,000. So our new net income is $100,000. So under this scenario, with less common fixed costs, we are able to say, let's eliminate that product because it's not profitable. And if we eliminate it, we increase the total profit of our company, going from $90,000 to $100,000. So that's it for the challenge exercises. Please reach out if you have any questions. Thank you.